Hi, I want to continue talking about some examples of competitive equilibria with complete markets trading one-period euro securities. And I've converted this Jupyter notebook into the beginning is a QuantEcon lecture. So to just remind you where we were, we've got Markov endowments, the setting. Complete markets, one-period euro securities, state continuous securities, kind of standard preferences. Everybody has the same preferences. They have the same beliefs. They have the same discount factor. We made CRRA utility functions because we wanted Gorman aggregation. We wanted to be able to compute equilibrium prices before actually figuring out what the distribution of wealth was. That afforded us a great computational ease. And we did a lot of work so that we could Bellmanize a bunch of things. So this is all just review. So I made these, I've made some Python code that'll do some examples for us. Okay, so we started with a Markov asset prices primer, and we talked about how we had a Q by Q matrix, an N by N matrix, Q, where Qij is the price at time t in state St equals Si of 1 unit of consumption when St plus 1 is equal to Sj at time t plus 1. So that's our pricing kernel. We had the price of a one-period riskless bond. We just summed up these euro securities prices. The gross interest rate, one-period interest rate in state I, is just the reciprocal of that. And we gave some examples. We gave some examples for some pricing formulas for cum dividend. This was a cum dividend stock and for an ex dividend stock. Okay. Okay, so set this up so that the matrix P is a matrix of transition probabilities. Q is a matrix of prices. And with our Markov setting, these have the same shapes. Okay, and I'll take a little digression here and talk about multi-step forward transition probabilities and pricing kernels. So we know from the property of Markov chains is that the ij component of the pth power of the transition matrix is just the k-step head transition probability. So the probability of St plus k equals the j state. Given St is in the I state, it's just P, the ij component of P raised to the power k. So this means, what this means is, that's the, we raise P to the power k and then take its ijth component. That's what this means. Well, similarly, the ijth component of Q to the k, just take that matrix and raise it to the k, that's the k-step ahead pricing kernel. So that's the price of 1 unit of of consumption to in state J at time date t plus k, given that today's state is I. That's what this says. Okay. And actually, these prices are actually embedded in these formulas, in this formula right here. Because if you take I minus Q inverse, that's just I plus Q squared plus Q cubed. So we can get assuming that the eigenvalues of Q are all bounded strictly below unity, then this is just can be written as a convergent von Neumann series. So these powers, so the way to read this is the current price is just the sum of the value of the dividend today, the value of the dividend tomorrow, the value of the dividend 2 days from now, and so on. So those powers of Q are embedded in that formula. Okay, so here I'm just going to take a little digression. It's going to be really useful to know. We know the law of iterated expectations from probability theory. There's also a law of iterated values, and it looks exactly like the law of iterated expectations. And we're going to exploit the fact that these Q's act a lot like probability matrices in some ways. So, so the law of iterated expectations. Let's go like this. The probability, the jth transition probability matrix can be gotten from the j minus 1th probability matrix by this recursion. All that this does, all we're just saying is p to the j is equal to p to the j minus 1 times p. That's how to read this. Okay. And what's the law of iterated expectations? The law of iterated expectations is, let's take some d, some measurable function of the state. We're going to think of it as a dividend. So if we have d as a function, a time invariant function of the Markov state, that's just a random variable that's measurable with respect to the state. If we take the expected value of d at time t plus j, conditioned on time t plus 1 information, that's a random variable that's measurable with respect to t plus 1 information. And we're going to take the expectation of that random variable conditioned on time t information. And the law of iterated expectations asserts that that's just equal to the expectation of d at s time t plus j conditioned on st. So E of E just looks like this. And the proof of that is you just write it out. Just write out what the definition of this is. Exchange orders of summations and over the t plus 1 and the t plus j, and then just notice that that's our j step ahead transition probability. Okay, so that's the law of iterated expectations. What's the law of iterated values? Well, first thing we notice is the pricing kernel for j step ahead arrow securities satisfies this recursion. That's just saying qj is equal to qj minus 1 times q. That's all this is saying, matrix multiplication. So the time t value in Markov state st of a time t plus j payout dt st plus j is this. This value, instead of expectation, I'm just saying it's the value of that payoff. Well, that's I just sum over states. I multiply quantities times prices. So that's the definition of value. Looks just like a conditional expectation. If this were, that value would be conditional expectation if this pricing kernel were just equal to probabilities. But in general, it's not. So that's a value. And the law of iterated values just asserts that the value at time t of a value tomorrow is just equal to the value today. So read this. So this V operator operates just like a conditional expectations operator. It's an analog. And the proof of this is you just write it out. You just write that out, and it just goes just as before. So that's called the law of iterated values. And it's an important property of, it's an important feature of asset pricing theory. Here's an exercise to think of. Could you get a law of iterated expectations if this transition probability, if it wasn't Markov? So instead of a S sub t, it was an F superscript t, so the whole history mattered. Could you get an equation like this? And could you get something that looked like this? Give you a hint. The answer is yes. And the proof is almost here, just with some replacements of subscripts with corresponding superscripts. And the same thing for the law of iterated values. I've just done it in this Markov context because that's what we're living in with this setup with Arrow securities being traded with a Markov state. Okay, so now we're just going to use what we created before our setting. Just to remind you, we have this transition probability. We have a list of k people. They each have an endowment that's a function of the Markov state. The aggregate endowment is y. We're going to have allocations. This is a pure exchange economy. The endowments are exogenous. We're just making them up. But the consumptions aren't going to be exogenous. This is a restriction on feasible allocations, and an allocation mechanism is going to somehow have to distribute what's available to people who want it. And we're going to go for a competitive equilibrium. So, competitive equilibrium, things we want to compute with these inputs, we want to take these inputs, and as outputs, we want to get Arrow securities prices. We want to get a consumption allocation. We want to get a distribution of wealth. And because when we make life easy on ourselves, we assume this utility function, this power utility function. Okay, then we got this equation for the pricing kernel, and with a little work, this was true for any individual k. And it also turned out it was true for the aggregate because of the way we specified preferences. So we automatically get as a first step, since p is an input, beta is an input, gamma is a preference parameter, and these yj's, those are just the aggregate endowments in state j and y. Those are all, everything here is exogenous. We made it up. So it's one step to get this pricing kernel. And it's a modification of the probabilities. Probabilities enter, but also preferences enter. This is, okay, utility function enter, the discount factor and the utility function. Okay, then we talked about how we could compute values. We computed the value of an endowment. We just used our asset pricing formula. This is the value of the kth person's endowment. It's a vector because it depends on what state you're in today. We then had to calculate debt limits, and the debt limits were, well, they were these, because that was kind of the maximum amount you could pay if you arrived in a state, if you never consumed anything ever again in any time or any state. That's what the value of your endowment is. So that was a debt limit that Arrow had to impose step by step. And then we got these continuation wells. Remember, those were something that came out. Those played a key role. Remember, when we went from the Arrow-Debreu economy with time zero trading to the Arrow securities trading with trading every period with a much smaller number of commodities, we had to compute these continuation wells because that was the key step in finding the state is an art. And it turned out as an outcome after we did that in this Markov setting, these continuation wells just turned out to be optimal portfolios. So if we knew what people, now we're kind of in a chicken and egg problem. If we knew what these continuation wells are, they're going to be state variables proposing the individual's optimum problem. But to figure out what they are, kind of in an equilibrium, we have to know what these alphas are. These and those are the shares of wealth due to owned by individual K. We have to know those in order to compute these continuation wells. So I have to figure out how to find them. And we know how to do that. Okay. Well, once we found them, once we found the continual wells, that's what people's optimal portfolios are. And now we have to figure out how to find the equilibrium wealth distribution. And we did that. And here's the deal. All we needed was prices and your endowment. So what this V is this is an operator that you tell me your endowment. You tell me your endowment. You tell me what state we're in initially. So I'll take your endowment and I'll multiply it by this V thing. So this is just going to be an inner product. So that's the value of your wealth. That's the value of the whole economy's wealth. That's your alpha. And you can verify they're going to add up to 1. So we could read this notation. That's how we get this. So once we have that, we've computed. So the way the flow would go is first we'd compute the Qs. Here's the way. First you compute the Qs, then you compute the alphas, and then you can compute continuation wells. And now you've computed optimal portfolios. Once you've computed this Cs, the alphas, you know the Cs. So now you know everything in sight. That's an algorithm. So think about that a little bit, because we're going to implement that in some code. That's what we're going to do next. Okay, so I arranged this into a description of a essentially pseudocode. to get ready to get an algorithm to actually compute a competitive equilibrium. So here's the thing. First, we use that formula above to compute Q directly from the aggregate allocation and our formula that we had above. Then I computed the distribution of wealth from this formula right up here. Then once we know the alpha assigned to each consumer, we're just going to, every state, we're going to assign alpha K of the aggregate endowment to that consumer for consumption. Then once we know those consumptions, we can go back and compute continuation wealth. And then once we know continuation wealth, we know individuals' portfolios. So that's the way the logic goes. So what we're going to do now is just look at a couple of examples in some Python code. I'll make this Python code available if you want it. So the first thing we do is we if you don't know Python, just bear with me and show you how to, a little bit. 3 minutes, I'll show you kind of how to read this. So what we're doing is, Python is, it's object oriented. So we're going to create a class. Python is very oriented toward applied economics because it deals with objects. So the philosophy here is that, Lucas's remark, every complete markets model is just like every other complete markets model. Python's going to take advantage of that. It's going to define a class. It's going to call it recur competitive. Could have been arrow Markov. Maybe that would have been a better name. And this class is just going to have, it's going to have inputs that I told you, that above. And what that's going to be. What are the inputs? What we're doing here is getting ready to find a class. It's going to be a state vector. It's going to be a transition matrix. It's going to be a list of endowments. This is endowments for everybody in the economy. It's going to have a risk aversion parameter, some preferences, and those are all the inputs. And then what it's going to do with those inputs, it's going to compute the derivative of the utility function, because I'm going to need that. And there's a formula for it, C to the minus gamma. This self thing is kind of that's a little bit of Python. It's going to define a pricing kernel. So what's the pricing kernel? Kind of go read this. It's Qij is equal to beta times this ratio, which was computed somewhere, times this transition probability. Well, the ratio is just going to be, here's ratio. It's going to be U prime over U prime of Cj to over Ci. That's next period's margin. So this is just that formula. It's going to compute a wealth distribution. How do I do that? Well, once I know the Q, I can compute this. It's going to compute continuation wealth. It's going to compute the price of a risk-free bond. It's just going to use that formula. It's going to compute a risk-free rate, and that defines a machine for taking our inputs. It actually has some default values. If I don't do anything, it's going to just give me these values. Otherwise, I can change them. Okay, that's it. And if I kind of want to use this, that's my machine. That's my machine. Let's create some examples and kind of look at it. So these kind of homeworks I'm making up for myself. Okay, so here, let's read this. I'm going to put some inputs. I'm going to create what's called, Python guys would call this an instance of this economy. It's an example. And so like this is Lucas from now on. These examples, these are all going to be, from Lucas's point of view, these all look alike because they're all just examples or instances of one of our economies that we've been talking about. So here's the idea. What do I need? I need to tell you the number of people. I'm going to say 2. Number of states is 2. What am I going to call the states? I got to do that. I'm calling them 0 and 1. I'm going to have a transition matrix. It's going to be 0.5, 0.5. That's the first row. Second row is 0.5, 0.5. It's like IID, if you think about it. It is IID. Okay. I'm going to make up these my endowments. I make those up. So the first person, going to call him, first person's name is 0. Python, you got to start numbering from 0, not from 1. So first person, first endowment, so Y1 is, he gets 1 minus S. And the other person gets S. The total, and S goes, look at S, goes between 0 and 1. So if I get 1, you get 0. If you get 1, I get 0. That's what this economy. The aggregate endowment just sits there. Okay, so how do we do this? So I generate an economy. So how do I generate an economy? I give it a name, X. I call this class, and I have to put in S, P, and YS. So my inputs are S, P, and YS. S, P, and YS. I filled in everything. So I filled in that economy. So now let's just see what we got. To just check, what are the endowments? Yeah, my endowments in, I'm the first guy in, when the state is 0, I get 1. When the state is 1, I get 0. So that's my endowment, and that's yours. The aggregate endowment is going to be. So let's compute the pricing kernel. Well, that's going to be, since the aggregate endowment is just 1, the ratio of margin utilities isn't going to do anything. So this is just going to be beta times the transition probabilities. So you can figure out for what beta I put in here. Just take 0.5, yeah. So the transition probabilities are 0.5. Now the Q is just proportionate. The risk-free rate, it's in every state, the risk-free rate is just 1.02. The gross risk-free rate is 1.02. The natural debt limits, I can compute those. Those are the values. Those are the present values of your endowment. Those are the endowments of the first person in state 0 and 1. Endowment of the second person states. So I've computed all that. Okay, let's compute the distribution of wealth. This is going to be fun. What do you think the distribution? Okay, you could ask yourself this. A little bit of. Here's the thing to do. Ask yourself this. All of this might have been kind of obvious. And I've computed prices, but I don't know the distribution of wealth. And now I have to tell you one thing now. Where does the economy start out? What's the initial state? I could compute all of this stuff before telling you what the, I could compute all this stuff before telling you what the initial state was. But to compute the alphas, if we go back up here, this formula, I have to know the row of that Q matrix that corresponds to that initial state. That's what I have to do. So this kind of alerts us. The distribution of wealth might depend on the initial state we start in. In principle, will it? Let's check. So come down here. Come down to example 1. Okay, so here we're going to compute. When the initial state is state, where are we? Is state 1, the distribution of wealth is person 1 gets 0.51 all the time. He always consumes more. Person 2 gets 0.49. The continuation wealths here are 0, 0. They've got to be, because that's how we're starting things off. No debts to begin with. Okay. So these are the continuation. These are the continuation wealths of the two people in. Okay. Yeah. Let me just go here. These are the continuation wealths in the. Just a second. Where are we? Oh yeah. Got myself mixed up. Yeah. These are the continuation wealths of the first of the two people in the first Markov state, which we're in the first Markov state. We're starting from that. These are the continuation wealths in the second Markov state, but we're not starting from there. Okay, so what happens if we start in state 2? Look what happens here. Look what happens here. These flip. These flip. Oh, now what happens is the second person is better, has more to consume ever more. And the first person has less. In the second state, would we start? Now we both start with continuation wealth 0. That flipped. But now the portfolios or the continuation wealths, they've also flipped. So I want you to think hard about what's going on there. And if we, because this is basically an economy in which in the first state, the first person gets 1, and the second person gets 0. So if we start off in the first state, we're starting off where first person has an endowment and might or might not have an endowment next period. It's IID. So when we start off in the first state, this guy for sure, when we start off, he's got 1 today, and then he's got equal probability, because I said it was IID, we baked that in, of getting the entire endowment, the whole future. This guy has 0 today, and then he has, the same from then on. So what this guy's going to do, the second guy's going to do is he's going to enter the second state with a lower continuation wealth. This guy, look, this guy got 1. This guy got 1, but he only consumed 0.51. What did he do with the rest? Well, he bought Aero Securities. And so he enters the next state with some wealth. This guy enters the next state with some debts. Okay, and that flipped here. Okay, so we got it. This is worth writing out and staring. Our little Python code did a lot of work for us. Let's do another one. Here's example 2. K and N, 2 people, 2 states. I don't know. I'm going to change what the. I'm going to make the states 1 and 2. I'm going to have IID. And now I'm going to give, look what I'm doing. I'm going to give the first person 1.5 no matter what. This guy faces no risk. Second guy faces a lot of risk. So the way to read this is the first guy is just getting 1.5 forever. no matter what. Really boring. This guy has exciting. He either gets 1 or 2 IID. So on average, he gets 1.5, but it flips around. There's risk there. So how do we create an example? We do it this way. Okay. Let's print some stuff. So here's the endowments. The first guy gets 1.5 in the first state, 1.5 in the second state. The other guy gets 1 and 2. That's how to read this. Here's the pricing kernel. Pricing kernel is kind of interesting now. It's not that boring. You could ask why is this happening? Well, the aggregate endowment here is, let's see, it's 2.5. The aggregate endowment in the second state is 3.5, if I'm adding right. So the aggregate endowment is fluctuating. Okay, so we calculate the risk-free rate. The risk-free rate's moving around. And it's going between, it's like, in the for zero state, it's negative interest rates, negative real rates, less than 1 gross rate. So interest rates are fluctuating from quite high to very low. We can compute the natural debt limits. Okay, now we can compute, let's compute wealth. Well, if we start in state 0, both guys start with continuation wealth 0. That's where they start. The way this works now is person 1, look at this, person 1 always gets more than person 2. And this is true even if you start in the other state. That's kind of interesting. So if you start in a second state, when person 2 actually has more times 0 endowment, nevertheless, person 1 ends up in the competitive equilibrium consuming more. Why? Why do you think that's true? Well, look what person 1's doing. This first guy has a perfectly constant endowment, and every period he ends up keeping a constant amount of it. He's going to keep this amount forever. That fraction of it. I'm sorry, I said this wrong. This guy's going to get, this is more complicated. This guy, you can ask yourself, is person 1 bearing any risk in equilibrium? He doesn't have to. Could just keep his endowment. But he doesn't. He ends up choosing, he trades in such a way that he ends up completely sharing risk with the other person, with the other type of person. So the first guys end up insuring the second guys, supplying insurance, and the reason they get this bigger share is it's an insurance premium. So think about that. Let's keep going a little bit. What's this example 3? Oh yeah, okay, so here's example 3. 2 guys, endowments like this. The endowments, they're going to be either 1 or 0. And they're just going to flip. The 2 guys are going to flip between 1 and 0, depending on what the state is. And then what this is, that's oh, look at this. What's the transition probability? This is interesting. The first row, if you start in state 0, you stay there with probability 1 minus lambda. With probability lambda, you go to state 1. If you ever go to state 1, you stay there forever. So this is a Markov chain with an absorbing state. That second state's absorbing. So there's going to be a stationary distribution, but we aren't going to start from the stationary distribution. That would be very bad for one of the agents. We're going to start with an arbitrary point. Eventually, you're going to go to all this is going to happen is you're going to be here, and then yeah, that's it. So we're going to set lambda equal to some number simply. We're going to set it 0.9. So for it's going to take a while on average to get to this state, but once you get there, you're going to stay there. Okay, so let's see the way this works. There's our endowment. There's our Q. Now that's pretty interesting. Look at the Q. It's going to mimic. It's going to mimic the P. It's going to be kind of have the same. It's going to resemble, but not be the same as a transition matrix. Look at the risk-free rate. Look at the risk-free rate. In state 0, it's really high. But in state, once we get to this state, it's really low. You could ask yourself what's happening there. There's the natural debt limits. And this is kind of interesting. In state 0, look at this. State 0, the first person who starts off with endowment, can borrow this amount. In the second state, he or she can't borrow anything. Why? Because in that in that second state, once you're there, that person has 0 endowment forever. So we rigged this thing up so that look at this. The second person doesn't have anything as long as you're in the first state. But once you get to the second state, he has essentially the whole endowment for the economy. Per capita, he has the whole endowment. He doesn't have it until he gets to the second state. So this guy, the first guy is doing well until we get to that second state, and then he's doing very badly. So so think about that. So what's going to happen is if we calculate the continuation wealths, they're actually quite interesting. And I ask you to look at that. So if we start in the first state, if we start in state 1, the continuation wealths look like this. If we start in state 2, they look like this. They're always going to have to sum to 0 across the columns. So that's what we did. Python issued this warning because in some states, the price of a risk-free bond is 0. What I've done here is I varied lambda, a whole bunch of these economies. This is what this little code does. We're going to generate. We're going to study what happens as we vary lambda. which is that probability that we go from state 0 to state 1. And then you can study what's going to happen to the distribution of wealth. If you start in state 1, interesting things happen. If you start in state 2, the poor first guy is never going to get anything because he doesn't have any wealth at all. Then I did an example 4. I won't go through this, but I'll kind of show you how to set it up. This is kind of like a REITs and Barrow example. Asset pricing guys do this. They created this kind of example. I made two people, but 3 states. And these transition probabilities. The first state, so here's the way I want you to think about it. The 0 states, first state, second state. Okay, so 0 state that's prosperity. I think, yeah, that's a lot of that's prosperity. I'll tell you what I mean. That's boom times. The second state where you go to, if you start here, you're really good times, but there's a chance you kind of go to moderate times in terms of GDP. Once you're in the second state, you'll probably stay there for a while because of the way I put these mu's. But there's a kind of if you move, there's a 50-50 chance you go up or you go down. If you go up, you go back to good times. If you go down, you go to this disaster state. And what's the disaster state is the third state. And once you get to the third state, you're going to stay there. You're going to stay there for a while. Actually, I'm going to make it so you only stay there for. You don't stay there for a while. You're only going to stay there for. Disasters happen, but they're not that long. Hopefully, that's what Barrow had in mind. There's this disaster, and then you leave it. So that's why I set this delta. And now, kind of what are the aggregate wealths? I set this up so that in really good times, the aggregate across the 2 guys is 1.5. In moderate times, it's 1. Adds up. And in bad times, it's only 0.4. So that's a huge collapse of the economy. Kind of a moderate downturn here. We'd come back up. Those are both pretty good. That's what happens. And you just compute things and print them out. I'll let you study this because there's a lot going on here. And we can figure out what happens when we start, what happens to the distribution of wealth and so on when we start people in different states. That's what you can read from here. So this kind of, we could go on all day with this and we can create much more exotic examples with these interesting examples that in applied work people actually have thought about. So this is what Lucas meant when I interpret all complete markets models are alike. Yeah, I mean, they've got, these Markov arrow models, it's got this list of, the way we did it, we've got this list of, what do we do? This list of inputs, for a Python programmer, that's what he or she wants to see, and a list of outputs. Okay, so, when Lucas made this comment that if you want to do first-class applied economics, you have to specify things precisely enough that you could either write a program yourself or give it to a programmer in terms of pseudocode. So we kind of did our pseudocode. We did our pseudocode down here. You could give this to a research assistant, or if you were a research assistant and you got this, you kind of know what to do.